Is it? It is other standards. What are the other standards we are going to use in financial reporting? Okay, financial reporting. When we say account standards, definitely there are some standards which talks about estimations, changes in policy, any correction for errors. Is it right? Any correction for errors. Any estimates we are doing, any changing policy of accounting policy, change of method of depreciation, is it? Change of method of depreciation, anything we are doing, we have to follow the rules. As simple as that. Rules are rules. Discuss the principle, what is the concept of comparability. Always changing in accounting. See, you cannot change a method. Okay, we cannot change a method from a straight line method, is it, from a straight line method to return down value method. Definitely things will change, is it right? You now understand historical cost, net realizable value, replacement cost. See the thing, the moment you are changing the method, the values will change, is it right? Here also method of depreciation, inventory. Is it? Inventory IS2. Is it right? There are two methods. Lower the cost or net realizable value. Is it? Lower cost or net realizable value. Straight line method. Again I am repeating this. We have done in IS 16. Most of the cases, in case of buildings, we use straight line method. In terms of plant and machinery, we use the return down value method. Straight away, no plus, no minus. Okay, no plus, no minus. This is the constant rule we will apply. Next, in some cases, what will happen? Most of the time, we will allocate depreciation to cost of sales. Unless and until specified, in some cases, they will tell us cost of sales is 60%, administration is 20%, and distribution or selling will be 20%. If that is the case, we distribute the depreciation in this way. Okay, we will distribute the distribution in this way. Why I am saying this? This is whatever we are doing this, it will be there in section C. Understand point? It will be there in section C. All the points. Fine. Now, we are talking about the fair value. IFRS 13 is nothing but the fair value. How you determine the fair value? What are the conditions of fair value? We are repeating the same things with some additions. Describe what is the principles of inventory valuation. Inventory is IS2. Is it? Inventory is what I told you, there are only two methods. One is lower the cost, the second is net realizable value. And there are some biological assets and agriculture produce. Is it right? Now, you are talking about agriculture produce. You have date trees. Is it right? You have date trees are there. Ratabs trees are there. Is it right? Well, you have to know how you have to value it. Is it right? You have biological assets. Poultry farm, Dhofar poultry is there. Okay, Dhofar poultry, Asafa poultry is there. Then there are biological assets. Fisheries is there. Is that Oman fish? How they will make valuation? Tomorrow you will do an audit for Oman fisheries. You will do audit for Dhofar poultry. You will do audit for Asafa poultry. Is it right? When you are doing audit for these companies, you should know that yes, this is the procedures for biological assets. You will do audit for date companies. Is it right? You will do audit for date companies. Is it? Then what happens? You should know how you have to make the valuation. Very interesting. IS 41. Okay? IS 41. We will do this. Okay? We'll cover this in detail. Now what happens? Is it right? See the thing. You have what is any changes which you are going, if you are making changes, you can change it. There is no restriction. You can change it. But when you are changing it, you have to follow IAS 8. Is it at IS 8? IS 8 for the, see here we are studying basics. In SBR we study in advanced level. Okay. Now, what you are a fair value IS 13. Okay. IFRS 13. Inventory IS 2. Is it right? Agriculture IS 41. As we have done IS 16, we have done property, plant and equipment. Is that we have done IS 20, we have done IS 23, borrowing government grants, borrowings. We have done IS 36, impairment of assets. Is it right? We have done IS 40, investment property. See, when we are in financial reporting as an auditor, we are not becoming expert in all standards, but we should have awareness. Okay, we should have what are the things. Is that IS 40? Likewise, you have, now what you are doing? We are adding IS 2, we will add IS 8, IS 2 inventory, IFRS is there, IFRS 13 fair value, and IS 41 is the biological assets. Agriculture and biological assets. Is that we will do auditing for everything. We should have complete. Now what happens in IS2? I told you there are two methods. Valuing, lower the value, net realizable value or cost. Whichever is the less we have to take it. Net realizable value or lower the cost. Net realizable value, same thing. Fair value minus cost to sell. Once we are doing, rule will never change. Okay. Cost to sell. Net realizable. What is the cost? Purchase or conversion cost. What we are doing? This is the methods. Okay. Valuation methods are there. LIFO, FIFO and average cost. Is that we LIFO, FIFO and we will not do this that much. I will say very simple. Is it? We are focusing on what? We are focusing on these two things. Is that one is net realizable value, the second one is cost. Okay. This is the first one. Come back to this. Agriculture. What initially we will recognize at fair value. At the end, we will make again. We will value it. See what? As simple as that. As simple as that. I will make it very clearly for you. You are talking in terms of poultry. Dofar poultry. Was it right? Asafa poultry. Is that what happens? They are talking about chickens. Is it right? Very simple. They will first have a smaller version. Then it will grow. Is that when the grow, it will become, the value will also increase. At some point of time, this is going to be ready to sell. Is that at some point of time it will become ready to sell. When it is ready to sell, then what we have to do? We have to revalue. Simple. Nothing is there. Very simple. Initial value, here also there is a cost. Over a period of time, the chickens are becoming ready to sell, the value will increase. When your value will not use the initial value, but we will revalue and we will calculate the what is the value. At the year end, revalue to fair values less cost to sell. You will have gain or you will have take it into profit and loss. Is it that you have trees? Is it that you have trees? When people are doing business with respect to date trees. Okay, people are taking this. When the tree is small, the value will be less. Tree is growing. Tree is becoming bigger and bigger. Plant is becoming bigger and bigger. The value will increase. Fisheries. Fish is also the same thing. People will do business. They will have small fish, value will be less. Fish is becoming bigger and bigger, weight will increase. Again you will revalue. Nothing is there. It is not difficult at all. Are you clear about this? IS 8, IS 13, IS2, IS, IFRS 13 and 41 agriculture and biological assets. Fine. Is it clear to you? Salim, Mazin, Hussein and Sumayya.
Yes, doctor.
Fine. This is little bit understanding. Well, again, there's not much calculations. It's only a theory. Where there is a theory, section A. Understand point? Keep it in mind. Focus this on section A. Okay? What it says, IS 18. See, while reading also, while revising, they will put a bookmark here. Okay? There is a bookmark here. Means you have to read this compulsory. IS governs the following topics. What is the selection policy, changes in policy, changes in estimates and any errors. If you have done any mistakes, definitely there is correction we can do. Is it right? We can do corrections. Corrections of last year. How we have to correct. Again, there is a rules are there. Okay? When you are selecting an accounting policy, any policy you are changing, rules are there. Any estimates you are changing, estimates in terms of what I will say, IS 37. Is it? I told you in the last class that I will teach this in chapter 17. Sorry, chapter 15. Provisions, contingent liabilities and contingent assets. First you have to write contingent liabilities, then you have to write contingent assets. Fine. This is where we are talking. We are estimating. Is right? What are the estimates we'll do? We'll do receivables. Is it right? Minus provision. Provision for bad and doubtful debts. Warranties are there. Now the concept of guarantee is not there. If you take the cars also, they give warranty. They will not. Nobody will give guarantee. You are doing purchasing gadgets. They say 1 year warranty, 2 year warranty. Okay. Rules are there. Is that everything? Every other thing what we are doing as per the bookish rules. Is that we will cover this in the next one. What is the policies? Wherever there is a bold, focus on that. There are specific principles, basics, basis. There are some conventions, procedures. There are rules and practices applied by the entity. In terms of what? Nothing. In terms of preparation and presenting of financial statements. Rules are there, principles. See, we are talking about we have a policy means, yes, it is going to be based on some framework, some guidelines, okay, some guidelines, some rules are there, some practices are there. We cannot do things as per the things. In the last case, in the last chapter, I told you about harmonization. You remember this in the last class?
Yes.
Harmonization. Okay. When I am repeating any words, keywords, it is from the revision kit point of view. Harmonization means you should have some common understanding about the financial statement across the industry. You will not be, all banks prepare financial statements in one specific format. Manufacturing companies specific format. Production companies specific format. Cost of sales means cost of sales only. If you are writing sales in the beginning, you will write either sales or you will write as a revenue, or you will write in the banks, you will take interest income. We start income statement with this only. Is it right? IS requires our entity, you have the options, is it right, to select and apply accounting policies. What it says, they will give you different methods. Depreciation, there are different methods, straight line method, return down value method. They gave you the methods. Now you have the option to select, is it right? That is the reason every manager, every company have their own assumptions. They have select and upright policies with respect to IFRS. Is it right? An interpretation to ensure that the information that is, it should be relevant, it should be reliable. That's all. I'm not going to take anything more than that. Is it? The information should be relevant, the information should be reliable. When we say you have the fundamental principles, enhanced principles. Understand point? We have done this conceptual framework. Fundamental principles are there, enhanced principles are there. What we have to represent faithfully, you have to reflect it into the economic substance in terms of monetary value. You have to be neutral. It should be prudent. Is that? It should be very conservative, very realistic. Okay. And most important, it should be complete in all material respects. These are all qualitative characteristics. Is it right? These are all qualitative characteristics. Is it right? These are all qualitative. Now, when you say qualitative character, rule, what the rule says, the general rule principles are normally unchanged. We should not change from period to period, because two things are very important. Is it right? You should be comparable. What we have said, we have to have a comparison. We have to have a consistency. Today I will tell you one thing. Tomorrow I will tell you another thing. Today I will say this method is like this. Tomorrow I will tell you this method. No, you change like this. You can't believe. You will not trust me. Okay. The most important. Always the financial statements will be given for 2 years. Any annual report, see 2 years. When we are doing the 2 years, we are comparing. Is that? When they are comparing, there should be consistency. 1 year we are using one method, another, next year we are changing the method. You should avoid, okay, consistency. That is the reason. Otherwise what will happen? It will be very difficult for us to make a comparison. 1 year we are using straight line method, next year using return down value method, again third year we are using straight line method. Profits will decrease, increase or fluctuate. Is that? Profits will fluctuate. That is the reason, comparison and consistency. We can change only if IFRS says that is required by, if IFRS gives notification, then only we can change. If results in the financial providing reliable and more relevant, if it is needed, compulsory, essential, then only we have to change. But when you are changing here, you have to give justification. Is it? A change in policy occurs if there is a change in recognition. Is it? Expense is now recognized rather than an asset. If it is needed, expense we are recognizing now. Is it? In terms of what? In terms of revenue expenditure. Revenue versus capital. Revenue expenditure less than one year. Capital expenditure more than 1 year. Presentation. Depreciation is now included in cost of sales rather than administration expenses. We have done this, is it right? 1 year we are putting in cost of sales, 1 year we are putting in administration expenses. I told you in the beginning of this chapter, cost of sales, always we have to put in cost of sales. Sometimes they will give that, yes, administration. This year there will be 20% for administration. Then you have to do do. Otherwise we should not. That is the reason they provide this information. Measurement basis are stating assets at a replacement cost rather than historical cost. Is that? If there is any changes is the replacement cost, we are using replacement cost in instead of historical cost, we can do. Means you can have the flexibility, but flexibility will be subject to conditions. Is that subject to conditions? Fine. Then only we can do. Okay. We'll complete this and we'll stop. Okay. Where is that? 1 minute. Period errors. Okay. 1 minute. One topic we'll complete, then we'll stop. This is accounting estimates. Okay. This is accounting estimates. This is also accounting estimate starts here. Is it? We'll complete policy and we'll stop. Okay. We'll complete the policy and we'll stop. That's nothing is there. Okay. Account means now you're understanding. We can change if IFRS will stay. Say we will say if it is reliable and relevant. It is reliable. We are justifying it, then we can change the policy subject to conditions. Otherwise we should not change the methods. Fine. Now accounting for change in the required accounting treatment is that now how you are changing, that's very important. The change should be applied retrospectively. Retrospectively means previous year also, from the beginning, with an adjustment in the opening balance. Retained earnings is nothing but the profits in the statement of change. Profits also we have to change. Expenses increase, decrease, profits will get affected. Get my point? We have to change with the opening balance of the retained earnings. Is that opening balance? Means when you say opening balance retained earnings means we have to think in terms of the last year. Means profits plus or minus. You can increase expenses or you can decrease expenses. But you also show the profit because it affects it have impact directly on profits or losses. Comparative information should be restated unless it is impractical. You have to restate the values. Is it? Again you have to present the values. Is it right? Unless until it is difficult. If it is difficult, you have to leave it. Now you will ask me what is difficult. We'll come back to this when we are doing examples. Okay. If the adjustment to opening retained earnings cannot be determined, the change should be done from future. Three things are there. First, you have to do from the opening balance, plus or minus. Fine. First option. Second option, you have to comparative should be means you have to last year and this year, unless it is difficult. If we cannot do for last year, at least when we are making changes, we have to make changes from either from the current year or from the next year. This much is only there for IS 8. Understand my point? This much is for IS 8. What is the in terms of policies? In terms of, we will cover this. We will stop here. Again, IS 8, what is there? What is the estimates? Okay. 1 minute. We will cover this. Okay. 1 minute. We will cover this. Okay. Yes. 1 minute. Okay. We will cover this. Now, it's not difficult. Okay. Can I continue or I should stop? Fast. Mazin, Salim Hussein, Sumaya.
It's okay, Doctor.
Sir, Dr. Tuski.
Huh?
Better, sir.